A proverb says, "The person holding your secret may not be your enemy, but they still have power over you." That is the hidden story behind banking in the United States. When you open a bank account, apply for a loan, use a credit card, or connect your bank account to an app, your bank collects a lot of information about you. Your name, address, social security number, income, account balance, transaction history, loan details, credit behavior, and sometimes even spending patterns. But here is what many customers do not realize. U.S. banks can share some of that information with other companies. Under the Gramm-Leach-Bliley Act, financial institutions must tell customers how they collect and share personal financial information. They must also explain when customers have the right to opt out of certain sharing with outside companies. But the key word is certain. You cannot stop every kind of data sharing. Banks may still share customer information for everyday business purposes, such as processing transactions, maintaining accounts, preventing fraud, responding to legal requests, or working with service providers. The FDIC explains that federal privacy law gives consumers the right to opt out of only some sharing, not all sharing. This is where it gets confusing. A bank may share data with affiliates, meaning companies under the same corporate group. It may also share data with non-affiliates, meaning outside companies. Some sharing is for marketing. Some is for operations. Some is for risk control. Some is for products offered jointly with another company. So when you receive that long privacy notice from your bank and ignore it, you may be missing the part that says who your data can be shared with, why it can be shared, and whether you can opt out. Now add fintech apps into the picture. In the U.S., open banking rules are meant to give consumers more control over their financial data by allowing them to share account information with authorized third parties. The CFPB finalized a personal financial data rights rule in 2024 to require data providers to make covered financial data available to consumers and authorized third parties on request. On paper, this gives customers more control. But in real life, it also raises a serious privacy question. When your bank, budgeting app, payment app, credit app, and data aggregators are all connected, who is truly responsible when your information is misused, exposed, or sold? That is why banks often argue that wider data sharing can create security risks. Fintech companies argue that data access gives consumers more choice and competition. Regulators are stuck in the middle, trying to balance innovation, privacy, and safety. For customers, the lesson is simple. Read your bank's privacy notice. Look for the opt-out section. Check whether your bank shares data with affiliates or outside companies for marketing. Review which apps are connected to your bank account. Remove apps you no longer use. And never assume that because your money is safe, your data is also safe. For banks, the message is even clearer. Customer data is not just a business asset. It is a trust asset. Once customers feel their financial lives are being passed around without clear control, the damage goes beyond regulation. It becomes reputational. So the real question is this: should banks be allowed to share customer data by default, or should every major sharing decision require clear consent? Drop your thoughts below and follow Privacy Needle for privacy stories made simple.